Welcome to Who Gets Your Legacy, family or government. Thank you for bearing with us through the technical difficulties. The answer to that question is we believe is family should get your legacy and not the government. My name is Wayne Clements, and I will be your facilitator for the evening. It is my great pleasure to be here. And thank you for taking time out of your busy schedules to come this evening and bearing with us through the technical stuff. It's our hope that it's going to be worth it in the end. You're going to come away with some great information. We have some awesome panelists who are all experts in their fields, and they're standing by to share their wisdom and knowledge with you. So again, my name is Wayne, and together with my business partner, Andrew is the technical side, working the levers to work out the bugs there. Thanks, Andrew. We run a real estate team out of the Newmarket office. There are 5 of us on the team, and we service most of the GTA. And since the beginning of 2025, we've sold just under $100 million in volume, and we've helped a lot of families relocate. Our clientele consists of first-time home buyers, move-up buyers who are looking for more space, right-sizers looking for something smaller or to get out of the market completely, and investor clients. It's a really diverse clientele, and we truly, truly love what we do. This seminar came out of 2 things. One was structuring my 88-year-old mom's estate, and the second thing was all of the different scenarios that we run into in buying and selling real estate. The real estate transaction can be a really, really happy occasion when you're getting married, when you've got a new job or a job location, or you've got a growing family. Those are all happy occasions. But sadly, the real estate transaction can also be a not so fun occasion when you're dealing with deaths and divorce. And what makes those not so fun occasions even worse is an estate that is not structured properly. And because when an estate is not structured properly due to an absence of the will or the power of attorney or even estate trustees, it gets a lot messier. It takes a lot more time and money to settle the estate, and it's extremely stressful for the survivors and who are already under a great deal of stress. And those of you who've been through it know what we're talking about. My family and I experienced it directly last May. My mom passed away very suddenly. She was in relatively good health, again, for an 88-year-old, but she was not ill. She was not in the hospital. And we went from planning to get her hair cut one day for a family event to her not being with us anymore. So it was shocking and very sudden, and a reminder to us all that life changes very quickly, and that sadly, none of us are getting out of this thing alive, and we don't always plan very well. Now, fortunately, for our family, we had done a lot of work with my mom's estate, and we weren't left with a messy burden when everything went down. It wasn't a financial mess. So it was a lot smoother, the transition. Our goal for this evening is to introduce you to some industry experts who are going to touch on the key points of estate planning and give you some direction on how to protect yourself and your loved ones, and introduce you to some options on how to manage those estate assets with products like reverse mortgages. We're going to talk about bare trusts and maybe segregated mortgages so that your estate or the estate of your loved one transfers easily and avoids as much probate tax as possible. So that's our goal, and it's going to be awesome. So here's how it's going to break down. We have 3 presenters. Our first presenters are Marissa and Stephanie Codsey from the Codsey Mortgage team, and they're going to talk to us about reverse mortgages. Our second presenter is Adam O'Neill, who is a financial advisor with Sun Life. And our third presenter is Damer Varanchik. Damer is a lawyer who owns his own law practice in Aurora. Each of them will have basically a 20-minute presentation, and all 3 of them will do all of their presentations. And then we're going to open up the chat line for a Q&A. Our goal is to be wrapped up by 8:30. So if everything goes, we're running a little bit late right now, but hopefully by 8:10 or so, we can open up the chat room. We can answer any questions you guys might have. So you can if you want, you can put your questions in the chat room for now, but we will get to them at the end, not during the presentation. And we'll do our best to get to everything. So, sound good? All right, let's get going. So who's going to join me here? Oh, the lovely ladies. Hello, ladies.
Hello.
How are you doing?
We are doing great, excited to be here, and yeah, we're happy about it. Yeah.
Good. Exactly. Well, we're excited to have you. So our first presenters are Marissa and Stephanie Codsey. Again, they're mortgage brokers. So welcome aboard, ladies. And they're going to be talking to us about some of the things that, most of what we're going to be talking about tonight is estate planning. But the other issue that our team runs into quite often is people who want to stay in their home. they don't want to go to, or they don't want to live with a relative, they don't want to go to a long-term care or something like that, and they want to be able to stay in their home. So you're going to be talking about a product that's going to allow them to make that happen. So now, before we get started, how about you give us a little bio on who you are, and then you guys can just jump right in.
Yeah.
Perfect.
Steph?
Yeah, so we are the Codsey Mortgage team and we service all of Ontario. We say we're your go-to mortgage people for life. We've been in the business for over probably 15 years now, and we are going to be here for you and your kids and probably your grandkids. So whether you're buying your first home or planning for retirement or just making sense of all the options in the market, we're here to help you make a stress-free decision on your mortgage and your financing. So there's no pressure, no jargon, just real advice from people you genuinely trust.
Love it. We do generally trust you. So you're going to talk to us about reverse mortgages today?
We are.
Yes.
We are.
All right, take it
All
away.
right. Yeah, so as you've already kind of heard, I'm Marissa and this is Stephanie. We are the Codsey Mortgage team. And as you know, today we're going to be talking about generational wealth, how to maintain our legacy, how to manage and protect it. We're going to go over a few solutions on how to access your equity so that you can potentially grow your wealth even further. And we're going to be, like Wayne mentioned, specifically talking about the reverse mortgage tool. And there's many ways that we can use that to help build and grow wealth, as well as protect it when you do pass away. So my hope by the end of the presentation is that you're intrigued and that you're starting to think a little bit outside of the box on how to use this tool to your advantage.
Let's go.
Yeah. Yeah, there you go.
Perfect. So there are 5 main ways to use your equity. So we'll be diving in deeper on a few of these, but these are the main 5: purchase property, lifestyle and maintenance, upgrade of your property, renovations, early inheritance, and debt consolidation.
Mm-hmm.
All right. So before we dive in deeper on these, we want to let you know on what exactly a reverse mortgage is. So it's still like any other mortgage, it's secured against your property. Unlike a normal traditional mortgage, you don't need income to qualify. You qualify based on your age and the value of your home. So the older you are, the more that you can borrow. The max borrow amount is 55% of the value of your home. So most folks are qualifying for around 10 to 35%, but of course that does go up. The funds you receive from a reverse mortgage is tax-free, and you can do whatever you'd like with those funds. And the funds can come in as a lump sum where you just get it as you get the mortgage, or you can do it as an ongoing payment that you get paid monthly instead of you making a mortgage payment.
Yeah. All right. Next page here. Yes, fine print, just to put it in here, is that you do you do need to just maintain home insurance, general upkeep, and now I want to mention is our no negative equity guarantee, which I think, is it on the next page? Let's just make sure.
No, I think
no. Okay. Yeah. Oops. Sorry. Here we go. Okay, we'll stay here. So I really do want to touch on this no negative equity guarantee because I think this is a big one that people like to that don't know about, actually, and I just want to make sure that everybody knows. So what does a no negative equity guarantee mean? And this is why people are afraid, I would say, of the reverse mortgages, because everyone thinks that you're going to lose your house and the bank's going to take your house at the end of it. That's not the case. Absolutely not. So no negative equity guarantee, the best way that I like to explain it is, let's say that you need a reverse mortgage and your home is worth $800,000. So now you get a reverse mortgage for $400,000 today, and that's what you get. $400,000, you take it out of the house, your property now has $400,000 of equity. Tomorrow, a nuclear waste facility comes in next door. They're using the plot of land next door and they're going to set up shop. And now your house is only worth $1. $1 because you have a nuclear waste plant beside you. But you have a reverse mortgage of $400,000. Oh my God, what are we gonna do? So, but you're stubborn and you're like, absolutely not. I'm not moving. I don't care if there's a nuclear waste plant. I'm living here for the rest of my life. Well, guess what? One, you never have to make a payment on this mortgage, on this reverse mortgage. You can live there as long as you want until you die. The house is still only going to be worth $1. This reverse mortgage will be growing, and then eventually you will die. Eventually you die, and now your kids have to take over your house, and they're like, oh my God, we have a reverse mortgage. Guess what? No negative equity guarantee comes in. Your house is only worth $1. So the most amount of money that you will ever have to pay back to the lender is what your value of your house is worth. So if the house is only worth $1, your kids are only ever going to pay back $1, even though you have, quote unquote, this $400,000 mortgage. It just gets thrown out. It's gone because your home is worth $1. And that's the no negative equity guarantee. You will never have to pay more than what your house is worth. And that's really important and really amazing that Canada has something like that here to protect us all. So that's what we're going to mention about that. So that's the Coles Notes of reverse mortgages. We're going to now get into a little bit of the juicy stuff. How can you use your equity to buy property? And we're going to go over the first couple ways here to use a reverse mortgage to buy property. So blanket mortgages and downsizing. Steph, take it away.
So blanket mortgages. So basically, this is a way to increase your wealth and not give the it's so basically a blanket mortgage. This is if you're buying more than one property. So let's say you have a property and you would like to buy another property and doing it with a reverse mortgage. So you could buy a rental or a cottage for your family, and instead of taking out your investments from your savings to buy that property, because taking out those investments will trigger major tax implications, and you don't want to drain your investments. You're using that for retirement. What you can do is take out a reverse mortgage, and they look at the value of the two properties together, and then they give you a reverse mortgage that blankets over your personal owner-occupied property and the cottage that you're about to buy. So basically, this way you can get a mortgage on a property that's not just your owner-occupied property, and you can do that by getting a reverse mortgage rather than using your investments. So a traditional mortgage typically covers one property, whereas a blanket mortgage will cover multiple. With our reverse mortgage lenders, we can go up to 3 properties that you can blanket on top of. So you could have your own personal property, a cottage, and a rental, or maybe, buying a property for family, anything that you'd like. 3 properties is the max. So you can do this without cashing out your investments. And again, that means less money going to the government, which is what we want.
Yes. Less income taxes.
Yeah. So the next one, we're going to highlight 4 other ways that we can use equity in your home.
Yeah. So the next one that we just want to quickly kind of highlight is our lifestyle maintenance and upgrading. So we also have in here downsizing. Downsizing is maybe that you want to live independently in your home. Maybe you have a 3-story home, but a bungalow would be more well suited to your current lifestyle. And I would say 30 years ago, a lot of people did downsizing where they would sell their current home and have a whole bunch of money so that way they could buy a smaller property and have a bunch of money in investments. Now it doesn't necessarily work as well. The values of properties, as we all know, even though, yes, they're a little bit depressed right now, they are still quite a lot higher than they used to be. So getting a reverse mortgage will help you access a little bit more funds, even if you are downsizing. So maybe you could pay full cash for a new, smaller home, but instead you keep more of your cash and take out a reverse mortgage, and you don't have to necessarily, and well, now you have more investments to keep you going for retirement. So within that is that we do want to highlight again, any funds that you get from a reverse mortgage, you can do any of the things kind of listed here. You can invest it, you can go on a vacation, you can maybe even just start paying for in-home care as needed, if needed. Just another way to help you maintain your lifestyle and within your home without having to go into a care home. And you don't have to buy property or downsize. A reverse mortgage on your current home will also allow you to access the equity. So maybe you don't want to leave your home. You can stay in the home that you've been in for your whole life. And yeah, we just want to highlight, I do want to highlight again, maybe your spouse needs nursing care, maybe you need some nursing care, like a PSW or things like that. A reverse mortgage can help with those costs, so it can help alleviate some of the monthly kind of stress that comes with staying in your home. And like I mentioned, you can put it towards your retirement savings tax-free, because the money you get from a reverse mortgage is tax-free. And maintain your way of life and mitigate taxes so the money you get can help you mitigate taxes as you slowly withdraw from your RSPs. Maybe you don't have to withdraw as much from your RSPs to help keep the income tax lower for longer.
All right. Next one, renovations. So again, if you're not downsizing, you can make your home easier to live in. Usually we want to stay in the home that we have built over the years. And so you can do things like, building in a chairlift, or maybe you need a walk-in bathtub. Maybe you need a ramp into the front of your home. So those are all costs that you're going to have to come up with somewhere. So instead of having maybe your kids front the bill, or you having to go into your investments to pull out funds to then get income taxed on, you can get a reverse mortgage, again, tax-free, to cover all those costs to make your home easier and more enjoyable for you to stay in and live in.
Yes.
You can also, I do want to mention, if you want to have a rental income, you can put in a basement apartment, renovate that to add income into your life as well. So lots of options with renovations.
Yes.
The next one
is early inheritance. So, I mean, honestly, did you know that 50% of first-time home buyers are buying their first home with a gift from their parents? So the average gift over the past couple of years has been steadily climbing upwards of 150K. We've even had some clients with gifts over 250K. So I'm willing to bet most of your funds for retirement are in your RSPs right now. And when you take large amounts from there, you're gonna end up with a very hefty tax bill. So again, this is just a way to avoid this extra tax payment. The funds that you get from a reverse mortgage are tax-free, and you don't have to make any mortgage payments. And this kind of gives you the ability to help out your children today, giving them funds to help them get into their first home, or maybe even upgrade into a home that will fit their needs without causing that big tax bill for you today. And also reducing the probate your children will have to pay after you pass because of this early inheritance as well.
Yeah. And the last one is debt consolidation. So now we know that this isn't fully in line with, building generational wealth, but it is about managing your wealth and paying off higher interest debt in favor of lower interest. It saves you a lot of money in the long run, and oh my gosh, takes that stress off of your back and your loved ones' back. So definitely, if you have any debt outside of your mortgage that you just don't want to have to look at, credit cards tend to rack up and the interest rate is very high. Getting a reverse mortgage to wipe that out and then provide you with a buffer is, I know it's helped a lot of our clients over the last few years. This has been probably one of the biggest reasons why our senior clients have gotten reverse mortgages.
Yeah. It's a mixture of debt consolidation and lifestyle management, I think, and just helping people feel comfortable as we move forward in life. So we've given you much and a lot of information. And if you can't tell, we are quite passionate about reverse mortgages and all the things that it can do for you and for your kids. If this is something if this sounds like something that your parents might benefit from, or maybe you might benefit from, please feel free to use the QR code that's on the screen right now to book a call with me, and we can see what might be the best solution for you. You can also email me directly, and if you're on Instagram, feel free to DM us there.
We've got a ton of reverse mortgage videos and information there as well if you're just poking around and not ready to make a call yet.
Yeah.
And that's it.
Thank you, ladies. In case you're at home scrambling around trying to write all that information down, don't panic. We are going to be sending out a follow-up email, and everybody's contact information is going to be included. So you guys will have everything. So don't panic. Thank you, ladies. That was awesome. If you are looking to refinance, if you're looking at any of these options or mortgage help, we highly suggest that you call Steph and Marissa. We deal with many transactions through every year, and when we're on the listing side and we're dealing with an agent who has a lender who is just not on the ball, we've seen deals fall apart because just because they don't have paperwork, or they ask for paperwork at the last minute. That's never happened with Steph and Marissa on any of our deals. They are super responsive, so they don't work bank hours. Now, I'm not saying they work 24/7, but you're going to be able to get a hold of them because real estate happens at strange hours sometimes, and you need a lender who, when if you can remove a condition or if you need an answer, they're going to be responsive, and they truly care about their clients, and they give great service. So we highly recommend you call them. So we will provide their information at the end, and they'll be back for the Q&A. So thank you, ladies.
Thank you.
All right, let's welcome our second presenter. No offense, Adam, you're just not nearly as good looking. Adam is a financial advisor with Sun Life. He runs a team of advisors over multiple locations. Hey, Adam, and you are a first timer here with us because we've run this seminar numerous times. So welcome aboard for the first time. It's great to have you.
Thank you so much. Oh, and we've got a little bit of echo on my end. Is that coming
Sound good to me?
already? Oh, perfect.
Yeah.
Okay. Thank you so much. Super happy to be here. Worked with Andrew before, and we chatted about earlier. Just met you here, but I look forward to meeting again in person. And thanks everybody for taking time out of your schedule to learn something tonight. I hope we can be helpful for everybody. I am a holistic financial planner with Sun Life Financial. I operate Attune Financial under that umbrella. CFP, COU, CHS, all the major designations. And I tend to be the quarterback of people's financial lives. So someone who is helping to manage investments, organize the insurance, look at accounting and projections, and of course, tax management as well. With that, why don't I pull up the screen? Are we sharing that, Andrew? I don't think so.
Yeah, take it away, Andrew.
Adam, your sound is quite choppy. We're not be able to hear you very well.
Oh, Okay. Let me see if that helps at all. Is that helpful at all, Andrew? I'm still getting pretty echo.
Apparently, there's some reverb.
Did that, oh, did that help at all, Andrew? No. Okay. I'm just switching back to microphones here. I'm hoping that's helpful. Any idea?
Adam, it sounds like there's two feeds going through your microphone.
Okay. Is that it? Can you still hear me?
You have AirPods.
No, now I can't hear. Okay. Well, now we've got the
While
reverb.
Adam's fixing this, I'm going to switch to Wayne. Will do an interpretive dance for us. Little known fact about him is that he really does a really good interpretive dance. Let's see him. There he is.
That's all I got. Don't make me sing.
Is that any better? Can you hear me?
A little bit better. Do you have a pair of AirPods or something you can put on?
I don't.
Or even plugins?
No, I'm wondering if this is the issue. Does that help everybody
So it's not.
hear me a little bit better?
That's a lot better.
No, I actually can't hear myself right now. But it's some sort of double microphone issue going on, or double take going on here. But I will speak into the ether, and I just hope that that works out for everybody. So thank you again. Holistic Financial Planner. I manage about 300 million for clients. I have a team of 9 or 10 in offices in both the beaches and downtown Toronto. Investments, insurance, and planning. And we're going to talk today about some of the major issues that hopefully can be avoided with proper planning. The biggest thing is tax. That's everybody's sort of boogeyman. And if I simple nutshell, my answer would probably be I make CRA as sad as legally possible. And one of the biggest things that most of my affluent clients want to do is minimize tax. Make sure that you're having as much going to their kids as humanly possible and as little going to the CRA. So there are only 4 true tax shelters in Canada. Last week's lottery winnings, we don't generally recommend that as a financial plan, unless you have some other way of making sure you win. But growth inside of a TFA is one, growth inside of your primary residence, and growth inside of a life insurance policy. Any other tax strategy that there is either a deferral mechanism or some sort of lessening mechanism, but it's really those first 3 that are the true tax shelters inside of Canada. So growth inside of a tax-free savings account, all growth experienced on any investments inside of a TFSA is tax-free. It's going to grow tax-free, come out tax-free, never going to get taxed again. Growth inside of your primary residence. If you buy a home for $1 million and it grows to 2, that is tax-free growth, never going to get taxed again. And growth inside of a life insurance policy. Most people in Canada are familiar with life insurance as a protection mechanism, and that certainly was the historical use case for it. Recently, and most of what we do in my practice with permanent life insurance, at least, is essentially creating another TFSA inside of a permanent life insurance policy. This can be accessed very similar to actually a reverse mortgage where you would access the value in your home. We want to grow a life insurance policy with investments inside that are growing tax-free. If you need to access those funds before you pass, you simply borrow against it. Again, that's coming to you tax-free. Yes, there is interest on that, but it tends to be prime plus 1. That would simply come off of the death benefit before it goes to your kids. In an ideal world with a perfectly efficient, perfectly tax managed estate, the second of a couple passes and only has three assets: a giant TFSA, giant primary residence, and a giant life insurance policy, all of which pass on tax free. It is very rare, if not impossible, for it to be just those three things, but as close as we can get to that as possible will make your estate as efficiently as humanly possible. A couple of the benefits of growth inside of a life insurance policy from an estate standpoint tends to be that it cannot decrease in value. So once gains are achieved, it can't drop. This doesn't tend to be the sole pillar of estate value investments, but like real estate, like market-based investments, like other things, it tends to be one of the asset classes. What I really like about the life insurance shelter strategy is in a scenario like in 2008, where your other asset classes might be diminished. So, for example, 2008 real estate was down, and of course, investment markets were all down at the same time. You can access the value of this life insurance policy that isn't down, it's still retaining its value. You're borrowing against it, and yes, there's interest on the borrowing, but that's going to be artificially low because, generally speaking, governments lower those interest rates as a response to those market and real estate crashes. And then you can either pay the loan back as the investments recover, or just let it accrue and have it dealt with upon your passing. One of the primary goals of just about all of my clients when we're doing retirement or estate planning is I want to stay in my own home on my own terms. And I don't want to have to sell this home or other real estate property when the market is not opportune. There are a lot of people dealing with that now. Home values are depressed right now. Everybody's trying to avoid selling if they can until things come back. You want to have as many diverse types of assets that allow you to sort of weather that storm. Let's just see here. Perfect. If you have a corporation, our tax code was basically written for business owners. One of the reasons that I am with Sun Life versus some other institutions is that Sun Life allows me to incorporate my business. One of the best strategies we have for corporations is retained earnings in the corporations. We can use corporately owned life insurance. I employ this myself. Most of my physician clients or dentists and vets employ this as well. Essentially, we are looking for ways to get money out of your corporation tax-free. Generally speaking, if you have money in a corp and it grows when you die, it's going to get paid out and it's going to be exposed to tax. If you stuff that money inside a corporately owned life insurance policy, it's going to both grow tax-free and flow out almost entirely tax-free. Essentially, the death benefit gets paid to the corporation, but it comes with a you can pay this out tax-free slip, which allows you to flow it out to any shareholder. So it does require that whoever you would like those funds to go to be a shareholder of some sort. It can be a non-ownership, non-voting shareholder, but those are certainly one of the big ways we get money out of corporations. Corporately owned critical illness insurance, where the coverage is owned and paid for by the corporation, but the give me all my money back at age 65 benefit is paid for individually. We can structure that. That's a more and more common strategy that we're using. Health spending accounts, fairly straightforward one, but in vitro fertilization, IVF, basic eye surgery, all braces, all of these very expensive things that tend to be out of pocket, and even with an excellent health benefits plan, are not generally entirely covered. You can use corporate dollars to pay for it. There are other strategies like an estate freeze if you want to pass your building parts or your business on to your kids, but you want most of the growth to occur under them. You can freeze it. There are a number of different strategies for those with corporations. A little bit more specific, so I'll sort of just give a bit of a sample platter of some of the topics that we talked about in general. One of the big things I do for clients, aside from just generally organizing their finances, is helping them avoid big errors. And there are some pretty common big errors out there that people make. There's a lot of misinformation, all sorts of people and pundits and information on the internet. Cottage schemes like selling your cottage to your kids for $1. Number one, at some point somebody's going to get audited. Number two, that that almost guarantees that you're going to have to pay capital gains tax twice on it. It ends up being a really terrible idea, but sounds like a great idea. Every time I've had a absolute bolt of lightning moment where I feel like I've figured something out and can get one over on CRA, when I run it by my accountant or some of my tax specialist colleagues, they're like, yeah, no, someone's thought about it before. CRA's pretty smart themselves. So if it sounds too good to be true, please speak to a professional about it. Investment panic during corrections, right now is a perfect example. The best thing to do in almost all scenarios is hold on, especially if you're in a diversified basket of investments. I actually use real estate as a lovely illustration of this point. If your home dropped by 50% in value, would you panic and sell your house? Of course not. You'd wait it out. Same thing happens in the markets. Again, if you're in one individual holding one stock and it goes way, way down, it may or may not come back. But if you're in a broadly diversified basket of holdings, mutual fund ETFs, or even a really diverse set of stock investments, in almost every scenario, waiting it out is the best possible thing. I talk people out of making bad decisions pretty much weekly, daily during scenarios like this, although most of my clients are fairly well trained now. The way that we deal with market volatility and market risk is making sure that you have pools of money that are aligned with your time horizon. If you need your money this year, it should be at no risk whatsoever. If you don't need your money for 10 plus years because it's for retirement or for the next generation, you could quite reasonably and safely put that at a higher level of risk reward position, which is going to get you a higher level of average return. One of the big sort of visualizations that I have clients, try and use is investing is, picture somebody with a yo-yo on an escalator, and the level of quote unquote risk on your investment or portfolio is the length of that yo-yo string, higher highs, lower lows, but it also impacts the angle of the angle of that escalator. The higher level of risk, the higher average rate of return. The risk is not that that investment is temporarily down. The risk is that you have to sell it while it's down. So as long as you're making sure you have enough short-term and medium-term money, that long-term money can be left alone to recover from just about any scenario. Another common error, selling primary residence too early. A ton of people want to sell their residence long before they're ready to retire. There are different scenarios that are right for different people. But if you have a 70-year-old who wants to sell their home and they'll just rent after that, the value in the home grows tax-free. The value of the investments after you sell the home will be taxable. So in many cases, that is not ideal. In others, it can make a ton of sense. So again, just talk to an expert or talk to a professional in most cases if you're going to make a life-changing decision like that. Too much wealth left in corporate or registered accounts. This happens a lot with the more affluent is, oh my gosh, I'm dying and I've got $800,000 trapped in an RSP. That is all going to come out the moment you die and get taxed as income in that year. So for many people, especially for those with shortened life expectancy, we really want to make sure we're drawing down those RSPs, RIFs, and LIFs so that so much is not trapped inside. If you have a relative or a parent or even a grandparent that has significant assets in registered accounts and they are terminal or having relatively short life expectancy, you probably want to get that money out over 1 or 2 or 3 tax years if at all possible. And again, that's just lowering that lifetime tax bill. More big errors, because there are so many. No plan. An absolute ton of people these days feel that financial planning is only investments, and it is not. It is tax management. It is order of operations of when and from which account to take funds. It's making sure that you are, structuring things in a proper way to minimize that tax. So a real plan is investments, insurance, retirement projections, tax management, and estate. For the vast majority of our clients, we reduce their lifetime tax bill by 20 to 45%, depending on what state they're in when they come to us and what opportunities are there. And most of that tends to be in retirement and on death at the estate level. Those are when the really big jumps and big tax reductions can happen. And those are when the big errors can occur because there hasn't been enough planning. Poor order of access of funds, that means just taking money from the wrong places first. This happens all the time, and really when financial advisors tend to earn their money is at the outset, approaching retirement, during the drawdown phase, and then in designing the estate plan. Primary residence joint with kids, in some cases it can make sense, but many times it exposes the parents to the kids' creditors, and you risk losing the primary residence tax exemption if the kids don't live in the house. There are scenarios where this makes a ton of sense, but there are others where it makes very little. Gifting too early, this tends to be less of a financial impact and more of a you gave it to kids who weren't ready for it type of impact. One of the things we do is behavioral and relationship coaching, especially with passing on a state. If there are excess funds that are going to be given to kids and grandkids, making sure that it is structured in a way so that it is received responsibly. If I had received a giant inheritance at age 18 or 19, I shudder to think what I would have done with it. I probably would have bought a boat and quite possibly a bar, maybe both, and I'm pretty sure those would have been extremely terrible decisions at the time. No wills or bad or outdated wills and powers of attorney. Please make sure you get a trusted estate lawyer or a lawyer who specializes in these things or is at least very familiar with it. But not having anything in place is the worst possible scenario. That means that Doug Ford has written or whichever premier we have at the moment has written your wills and powers of attorney, or that the decisions are going to be left up to a judge or justice, and we do not want that. I love my little sisters and I love both sets of my parents, but neither of them are the right choice to raise my kids if something were to happen to my wife and I. And there's absolutely no way that some random judge would be able to make that determination. So you want to make sure that you're laying these things out. Ignoring inflation as a part of your financial plan. Inflation is becoming a larger and larger issue as time goes on. So making sure that that's factored in is a huge, huge part of things. And then, just one second here. Here we go. Did I miss one there? Nope, that's it. That's all I have for right now. This is just a shot of my team. But I'm happy to answer any questions during that Q&A period at the end. And I can't really hear anything, Wayne, so I'm going to mute myself and turn up my audio a little bit and hopefully avoid some of the reverb.
That's awesome, Andrew. Adam, I keep calling you Andrew. I got to stop doing that. Sorry, Adam. Great stuff, great options there. And to your point, there are a lot of so-called experts online and Instagram and TikTok and all of that stuff. And you really have to be careful and deal with a professional like yourself who knows the business and someone, right? Really, you need somebody you can trust who has your interests in mind, right? And that's really what it is. You've got to sit down with somebody who looks you in the eye and says, "Yeah, I'm in your corner," and that's what you do with your clients. And it's never too late to start a plan, right? I think a lot of people are afraid sometimes to sit down with a financial planner because maybe they're embarrassed where they are in their life or something like that. And it's like, hey, it's never too late to get something organized and be, and have a plan in place and just have something set up, right? So call Adam. He's going to take good care of you. Thanks, Adam. That was awesome. All right. Batting cleanup. Damer, who is a barrister, solicitor, and operates his own law firm. Hey, Damer, how are you?
Damer is muted.
Damer, you might be muted.
I am. How's that?
Much better, much better. Why don't you tell us a little bit about yourself and what you do, and then I'll let you just jump right into it because no one wants to hear from me. Everyone's sitting tight for you.
Thank you. Let me just turn this camera up. Well, good evening, and thank you, Andrew and Wayne. I think this is my third seminar with you. Always very enjoyable, and each time I myself walk out with some extra knowledge. So just shows you we're never too old to learn. And every one of your participants always brings one or two kernels that are extremely useful in my practice. And Adam was no exception to that, so thank you. I am a solicitor. I do not do litigation. I have three areas of practice. I do a lot of real estate, both commercial and residential. I'm a business lawyer by trade, and I have done a lot of estate planning over the last 30 plus years. I'm in one of these unenviable positions when people come to me, they want to know what's the worst thing that can happen. They never want to know what is the best thing. So I'm generally a bearer of bad news because I have to scrutinize everything and show where the pitfalls are. Having said that, there's some positives to this, as I can certainly help you, as can many lawyers like myself that do estate planning, navigate you through what you may wish to consider doing for yourself and your family. And many people avoid estate planning because it makes them feel mortal, and they don't wish to think about dying or incapacity. And yet, from my experience, probably the biggest gift you can give your family is to organize your affairs early on in the process, because we never know what the future brings. And I never worry so much about critical illness as I do about a client that steps off the sidewalk, gets hit by a bus, or gets in his car thinking he's going home for dinner to his family and gets involved in a serious car crash, and no contingencies were planned. So it's an important thing to plan for your estate. It shows some care and responsibility to yourself, and more importantly, to your loved ones. And it also protects what you've earned, and whether it's through Adam or any other financial advisor, or what you yourself have been able to save, but you'd like to protect those assets. So estate planning, in essence, is something that you manage during your lifetime, but it takes effect primarily after you die. Now, there's a misnomer out there that if you die without a will, that the government will take everything. That is not true. The government doesn't take anything. Ontario has legislation in effect that spells out who inherits your estate if you die without a will. And it's basically a next of kin order. So whether it goes to parents if they're alive, if you die without children, it goes to parents, or goes to your brothers and sisters. You have a spouse, it goes to your spouse. But if you got spouse and children, then it goes to them, but in different proportion depending on how many children you have and how big your estate is. So it's what's called a preferential share, where your spouse gets a preferential share, currently at $350,000, and then the rest is split depending on how many children you may have. So the benefits of having a will is, in essence, you're making your wishes known. You will have a peace of mind. You will provide for your family and stability for your dependents. You may have children that are in disability. It is a great way of providing, and you may have heard the expression enhancing trust. So it allows you to set up a trust for a disabled child for their lifetime. And you can set up who will manage that trust for your child. How will the child receive benefits from the trust without impacting the benefits received from the government? So a lot of different things can fall into that. You decide who you trust to administer your estate when you are gone. These are your executors. You're entrusting them to make financial decisions for your children and or your spouse. It potentially avoids family disputes and protects family relationships, because everything can be set out clearly in your last will and testament. If you don't have one of these things, then family members may argue in terms of who will apply to the court to be your executor and to administer your estate. And there are fees involved, or compensation. Executors in general get about 5% of the value of your estate. So that could be a substantial amount that somebody's going to get. You may set up bequests, whether it's monetary or chattels that you wish to leave behind, like specialty heirlooms, jewelry, art, anything of this nature. If your children are minors, especially if you have a very young family, it's difficult to know what the maturity level of your children will be at the age of 18, 21, 25. As Adam alluded, they may end up in the bar taking a trip over Europe at the age of 18 if they inherit, whereas you might want to shelter their inheritance till they're older, hopefully wiser, and are able to utilize that to launch themselves in life if you're not there to assist them. So, a lot of benefits in doing things of this nature. And you can also decide who the guardians of minor children will be. And the courts would give great weight to that, especially some families are not as harmonious as others. And there might be competing interests as to who may want the children. Um, Unfortunately, in this many years of practice, you see a lot of different things occur. Sometimes family fights over who will have the children. And they can do it for altruistic motives, or they can do it because they think they will control the funds. Um, You may also deal with funeral wishes within the will, so that whatever arrangements you wish to make, visitation, where you're going to be buried, cremated, any of these things could be set out in the will. And there's obviously, as Adam alluded, some tax planning strategies that we can do when we're planning your estate. Now, for people that have corporations, if they own their own business, it is sometimes beneficial when there's substantial assets in those companies to have what we call a two will system. And let me explain the difference. There's two kinds of assets: those that are in the public domain, such as the house that you own, and those that are private, such as a closely held corporation. You know, John Smith Heating and Plumbing Limited, that may have $500,000 of cash, equipment, and all of these things. When and assume that you are now a single individual for purposes of this illustration. When you die, if the house is to be sold, that house is in the public domain. If it's just in your name alone, your executor needs to obtain a certificate of appointment to be your executor issued by the court so they can sell the house, because the land registry office will not allow the deed to be transferred without somebody being legally appointed. So the value of that home is now subject to a probate fee of 1.5%. That can be substantial in the GTA. On the other hand, when you own your own corporation and you have certain assets in there, you can will those shares to one or more beneficiaries. And because the corporation is not in the public domain, it's privately held, we can transfer those shares to your beneficiaries without obtaining probate. So you're saving 1.5% of the value of that corporation and its underlying assets. So obviously, certain savings. Some people collect works of art, sculptures, um, cards, trading cards, things that have tremendous value. All of those assets can be grouped into the private holdings or the secondary will and minimize probate. You will not minimize the capital gains taxes that you will pay because that's a different issue. But a 1%, 1.5% saving is still substantial depending on your asset allocation and net worth. One of the things that I would like to stress is, as the panel has already said, there's a lot of misinformation out there today on the internet, TikTok. Some of it deals with things that apply in the United States and not here. The terms are, just put it in a bare trust, put it in a family trust. These are not simple things. They're extremely complex. They have a tax implication that can be serious to you. And it's not an easy thing to do. So you have to be very careful. And it's very important to speak to an experienced solicitor that can guide you through things. And I will give you just a little example of how complex things can be but we sometimes assume they're simple. I had a client call me and basically said, my wife and I live in our home with our daughter and her husband. We own the home 50-50, but my other child is contributing and paying the mortgage, doesn't live in the home, but she and her husband live in a different house. But I want to make sure that she also gets the house. But we don't want the husbands to get it. And can you just do a trust for us? To him, it was very simple. Till you start saying, well, what happens if one daughter dies? What happens if there's a divorce? What happens if the other daughter stops paying the mortgage? What if she gets divorced? What happens if you have a family dispute? What happens if you and your wife become disabled, or one dies, one is disabled? Who is going to carry the expenses? There is so many nuances that one has to consider. And the last thing you want is to prepare something simple, things go awry, and then you're going to say, oh my God, I wasn't protected. Why wasn't I made aware of these things? So quick solutions, quick fixes generally don't work. We're dealing with large sum of money, great values, things that you have earned over the course of a lifetime. They deserve care and protection so that your wishes are carried out properly. Um, Trusts used to be extremely popular. They are less so now. You really need both legal advice and accounting advice if you're going to set one up, to understand the ramifications of how to set it up correctly, who the beneficiaries are, how you're going to move assets into the trust, how is the trust taxed, is there what a trust has a finite time period of 21 years, at which point in time either the money has to be paid out, taxes have to be paid, it can be rolled over again, but there's a lot of tax implications in setting something up. There's ongoing filings involved, there's accounting fees to be paid. Um, the trustees have to disclose on their tax returns that they're trustees of a trust. So there's reporting involved both for the trust and the beneficiaries and the trustees. So a lot of nuances that enter into it. So it's not a very easy thing to do. It does have certain advantages in certain applications, but once again, for the purpose of this presentation, a little bit too complex to get into any great detail. Over and above that, you should also consider what happens prior to your death if you become incapacitated. So in general, when we are dealing with a family and are doing an estate plan, we also consider provisions for their incapacity, especially as people age. But illness can strike you at any time. You can be involved in a car accident and be you could suffer brain injury, be in a coma, which necessitates that someone has the power, legal authority to deal on your behalf, both in terms of what kind of care and treatment you're to receive, and how your finances, your savings, your house, your business is going to be managed during your period of incapacity. That incapacity could be permanent, it could be temporary. Now, one thing to remember is that the power of attorney dies with you. So once you die, whoever holds the attorney over you and your assets no longer has any power to deal with those, and then your executor takes over. Sometimes those are not the same people. And the one thing you have to remember is that if it's the same individual, checks and balances, an executor can force your attorney to account for what they did while they manage your estate. But if they're one and the same, very little can be done. They're extremely powerful documents. So let's deal with power attorney for personal care. So that gives someone the right to make medical decisions for you when you're incapable of doing so. In general, spouses appoint each other and then they appoint either children or siblings or another person that they trust. And it's really a life and death decision in who you're appointing because you could be critically ill or injured, and someone will have to make a decision, possibly whether you should be on life support or resuscitated, or what kind of care and treatment you're to receive. So you need to pick very carefully. Within this document, you can include what's called a living will. A living will is an expression of your wishes. It has no binding effect on your attorney. Your attorney still decides what happens to you. Do they, in vernacular, pull the plug or not? But the document spells out your wishes and gives them some guidance in terms of what they should do in that eventuality. You do not have to include it, or you can specifically put into this document that you do want heroic measures undertaken. And sometimes that depends on your belief. You can have more than one person to make that decision. You could have two or three, majority rule. So there's a lot of flexibility. And then there is also a power of attorney for your financial affairs. And one of the things you have to be careful, sometimes we sign these documents with the bank. You have to read it very carefully to make sure that it does not invalidate any other power of attorney you may have done that you wish to continue to be in existence, and that the one you signed at the bank only deals possibly with certain bank accounts that you may have with that financial institution. You do not need to have the power of attorney that's done at a bank. A properly down power of attorney for property and finance through a lawyer is binding on the bank. They may give you a hard time, but we're able to convince them that it's a valid document and they have to honor it in the event of your incapacity. Some lawyers like to make the document effective immediately upon its signing. In other words, you go into a lawyer's office, you appoint a spouse or a friend or a child, if you're not married, let's say, as your power of attorney for financial matters, and it becomes effective the minute you sign it, and somehow they get a copy. Believe it or not, I have seen people use that document fraudulently and take money out of parents' account. The other way to do this is to make the document come into effect only when you declare it mentally not competent by a capacity assessor licensed by the province of Ontario or a medical doctor. And it's only with this letter of incapacity and your document they're able to use the power of attorney to go to the bank and deal with your finances, or even go to somebody like Adam and say, all right, I'm the POA. Can we deal now with these investments? It is a very, very powerful document because the person you appoint is stepping into your shoes. They can do anything and everything that you can do. And so you have to be extremely careful who you pick and that you trust them. I generally suggest, if you can, that you pick more than one individual to act jointly so there's checks and balance. But it is very important to have that in place. If you do not have a valid power of attorney for property and you suffer some type of calamity, that you're no longer able to make your own decisions, your spouse will not automatically be allowed to make those great financial decisions. No one will take her instructions. There's too much risk and liability if there's misfeasance. They will need to get a court order. That is expensive. When you apply for a court order, the public trustee's office may get involved and they may want a financial plan. They may want to review that plan annually. There's a lot of variations that can occur. If you live in a home and you may be released from the hospital and say that you are now in need to always be in a wheelchair. You have some capacity, but not full capacity. Your spouse may not have the funds to renovate a house to put a ramp and enlarge doorways. She may need a mortgage. She cannot obtain financing to renovate that home without a valid power of attorney. No one would deal with her. So, in some respects, from my perspective, the power of attorney documents are even more important than the will. The will, without the legislation provides, it all goes to your family, your next of kin. Um, Obviously, if you make it, you can exclude certain people, include others, include friends, whatnot. So it gives you greater flexibility. But it's not the end of the world if you don't have one. The power of attorney, extremely important because, as we can see, dementia is on the rise, illnesses are on the rise, and incapacity is on the rise. So those are important things to have. How do you start? I think you need to find some time to assess your family situation, list your assets, make a decision who should have them, speak with a lawyer, your financial advisor, an accountant if you use one, review your plan. I would say anytime there's a change in circumstance or approximately every 5 years. I've seen some estate plans that work for 10, 15 years. There's no need to change them. They're very simple. I have some that need to be adjusted periodically because circumstances change. And so, in conclusion, if you take some proactive steps to have these things in place, um, when the inevitable occurs, as it will for all of us, your family will be thankful to you that you've taken the proactive steps to make sure that there's an orderly transition of your assets to your beneficiaries. But thank you for your attention. Thank you again for having me. And if you have any questions, I'd be pleased to respond.
Thanks, Damer. That was awesome, as always. And I think, that what you said to start off about, you know, having a just sitting down with your family. And I know my wife's family, they do it every year. They have a family meeting, and it's just their parents and the four siblings. And every year they sit down and they look at uh, their plan, their situation, and they know exactly who's going to get the china cabinet, and they know exactly what rings. Jane knows where all the stuff is going, and it's just very very clearly laid out. And there's little emotion. They order a pizza, and they have a glass of wine, and then they talk about it every year, and that way their wishes are known, and then they can put it on paper, and they keep minutes too. Like it's a pretty serious meeting. And if there's something needs to be changed, they reach out to the lawyer and they change it or whatever they got to do. But it's just that regular. It's that thing about sitting down with your family and just making your wishes known, right? And then having a plan to do
Even thank you. And just to segue into that, even with if you have younger children, let's say preteens, something like
it.
that, it's a uncomfortable topic, but it's worthwhile sitting down and saying, something happens to mommy and daddy, who would you want to live with? The answer might
Right.
surprise you, and you can ask them why. And it could be that you're thinking of one family member who hates pets, and your kids are so attached to a pet. So imagine now you're gone, they're moving to a family member, they're losing a family pet. So
Right.
compiling grief on top of grief. So there's a lot of permutations here, but open conversation is extremely helpful.
It is. You're absolutely right. And I think also to your point, it's the people who step off the curb and get hit by a bus. That's the one that is shocking to everybody. And if there's nothing there at all, that's the one that's really really difficult to deal with. But two, the people who are dying slowly from long term, from an illness or something. Sometimes it's the last thing you want to talk about. Like, all you're worried about is their care and getting to their treatments on time. And the last thing you want to start talking about is their death. So either way, it's hard, but it's again, it's a necessary conversation to have, right?
And the other thing to consider too is sometimes it bears pointing out to people that are terminal that there's things that can be done in advance to save probate fees.
Mm-hmm.
They can meet with Adam and transfer, put beneficiaries on it on everything so that it passes outside of the estate. They can add people to the title to their home. They can transfer the home. there's a lot of proactive things that can be done in those situations where we anticipate that to occur within a certain period of time.
Mhm.
And it does save a lot
That's
of
a good
money.
Yeah, that's a good segue. Maybe we can bring everybody back in. And first of all, I want to thank all of our panelists for that. And I think touching on that, that's the one thing that we did with my mom's estate was we made sure my brother and I were beneficiaries on as much as we could. I know there's certain things that you can't, you stocks and that type of thing that you can't make beneficiary of, but there's a lot of things you can make yourself a beneficiary of. And we put ourselves, we set up a bare trust on my mom's home as well. So I don't know if Adam or Damer, if you guys want to talk about maybe a couple of those things, about some simple things to do that you can do with somebody. You can go to the bank and do it easily. That saves yourself a lot of time.
I will say, and I'm still getting that reverb there. I
You're
will say
sounding
that
better now.
going to the bank these days tends to be a little bit more difficult than it has been in the past. Bank managers have a lot less leeway than they once did. And what you think might be, you really have to dot your I's and cross your T's if you're going to do joint accounts or if you're going to do joint access to a safety deposit box. You want to make sure that the powers of attorney are absolutely airtight because getting them registered can often take a significant amount of time, and they're you might have to be done multiple times, registered with different institutions. That's just the failing of institutions these days as red tape and less discretion uh, becomes more prevalent. Uh, but some really common things, get bank accounts consolidated, having a list of what bills are getting paid and by whom, which accounts they're coming out of. My father, my stepfather, and my mother. I have told my stepfather he's not allowed to predecease my mother because she knows where absolutely nothing is, where none of the passwords are, what the accounts are, and we've been working very diligently to try and get those organized. Whereas he's an incredibly just put together individual who's very organized. My mother is not, and I inherited some of that, and I've been fighting that my whole life, which is why I do some of the planning that I do. But just generally getting organized. Um, in my particular family, my grandmother has two daughters and one grandchild, and there was no fighting over money at all. There was fighting over one particular thing, which was a sterling silver turtle that if you press the head down, it rings and I guess calls in the staff for the next. Apparently, the family was rich at some point many generations back, but it was nothing to do with money. It was all about a thing. And I've run into multiple scenarios where it's dad's classic car, mom's wedding ring. Something of sentimental value tends to be where things really get tense. Um, the other half is fun, but those are the things that having that conversation really would go a long way to avoiding. That, and if you really want to make your kids hate each other, leave them a cottage with no rules or structure around that. 9 out of 10 times, just sell the cottage. The kids will, or equalize for it. Yeah, one kid won't want it, or won't use it, or won't be in a position, and they'll just fight over it.
Right. Okay.
The cottage is
Andrew,
probably
do
the
we have
most
questions?
difficult thing to decide.
Yeah, yeah. We have some questions. Can you guys hear me okay?
Yep.
Okay, cool. So they're actually, right now, they're both for the Kotze team. And Nico asks, what's the interest rate on a reverse mortgage?
It is a little bit higher. So it changes like, your regular mortgages change. So I generally say it's about 1% more than your traditional mortgage.
Yeah. Yeah.
Okay. And here's another one. Does the accrued interest eat up what's left of the mortgage?
So yes, of course, it's going to be increasing if you're not making any payments. But generally, it takes a little while before it starts actually eating into the equity.
Yeah.
It also, because Generally, homes do increase in price over time. I know the last couple of years it's been relatively flat to going down slightly, but over a 10-15 year period, you will see the equity increase. So, therefore, your kind of mortgage and equity are both increasing at the same time. For a lot of our we do like a spreadsheet of what it looks like, and it takes about 10 to 15 years to start really eating into the equity. And again, you start at a very low mortgage loan to value amount, depending on your age. So max is 55%, and that's generally if you're getting a mortgage at maybe 85. So if you're 60, you're getting a much lower loan to value to start. So it takes quite a bit of time to eat into your equity.
Yeah. So just to point that out is like when you're younger, that's why we mentioned you're probably on average getting 10 to 20 to 35% loan to value, which means that's the max amount that you can take out on the reverse mortgage. So that's pretty low, which means if you're getting 10%, that means you have 90% equity to start out with, which is going to take quite a while for 10% to start eating into that equity.
Yeah.
Okay, great. And Damon,
Yeah.
I think this question would be more for you or maybe Adam, but if someone adds a child to as a co account owner on a bank account and their assets, namely money in the account, upon that one person dying, does it pass to them without probate?
If the account is joint, yes.
Okay.
But you just have to make a difference between a joint account and having signing authority over an account.
Mm-hmm.
Because the minute the individual dies, your signing authority stops. The account is frozen. A joint account, you can always access it. And the banks will require both the account holder and the child to attend at the same time at the bank to make a joint. They will not allow you to come individually.
Okay. And to be clear, once they're joint, it's their
I
money.
just add to that and say that a lot of this really should be done beforehand. The earlier done, the better. And in some cases, quite frankly, if we know that the end is near, removing the assets from a joint account and just putting it in the other individual's account to make sure it's more easily accessible. Um,
Mhm.
I'm not a huge fan of segregated funds, but half the time we use them just to get the money to the kids more quickly and easily because it's not going to get held up by probate or potential other things. Um, really making sure that there's cash on hand for the executor and for the next of kin is a huge thing that I would recommend for just about everybody.
Right. And on our end, as realtors, when we deal with people that are selling estates and they haven't gone through probate, a lot of times people don't understand that we cannot sell the property until it goes through probate. And sometimes, depending on where you live, it's longer than others. It was upwards of Toronto, in Toronto, and it was upwards of 18 months at one point. I don't know how long that is now. York Region was a lot less, but that's also a consideration a lot of people don't really understand.
Took us about 6 months in Toronto to get mums to get our state certificate.
Toronto is a
Four
law
months.
unto itself. You're never dealing with the same clerk that's looking at the probate papers. So I can submit my application, and one clerk will look at it and say, "Oh, can you just correct this little thing?" So we do it. We send it back, and then a second clerk looks at it about 2 months later and sends it back with their own correction. And this could go on for months, and you can never get anybody to speak to. I must say, York Region has become extremely efficient. I'm getting my certificates now within 2 months tops.
Hmm, that's great.
That's quick.
So things are changing. Mind you, the pandemic is finished.
Yeah. That's it for questions. To be honest, I think you guys had a lot of information and gave a lot of answered a lot of questions during your presentation. So, but we will be sending out. I wanted to note some notes on and the decks, and also all of the presenters' information. So, should you have any questions, you can feel free to contact them directly or ourselves if you're looking for some real estate questions. But Wayne, I'll leave it to you and
Sure. I've got one more for Damer because my buddy's mom passed away suddenly last week, and so the house was not in a bare trust, so it's likely going to go to probate. And his question was, what triggers the going to probate? Is it the dollar value? Does every property go to probate, or what's the trigger?
I would say 99.9 of them may need to go to probate. There's a little known thing such called the first dealing. And what that means is that if the property was held by the individual, let's say they bought it from a builder, and they are still the original owner, and they've been the owner for 30, 40 years. So the first dealing is the transfer now from the deceased to a new buyer. I can bypass probate. Extremely
Oh,
rare situation, extremely rare. It's technical, very technical. I would say to you that regardless of what the value of the real estate is, because it's in the public domain, you need probate. If I
okay,
have an estate that doesn't have real estate and it's below a certain amount, I can usually persuade a bank to allow it to go to the beneficiaries without probate. But once you have real estate involved, you need probate.
okay. That's great. That's awesome. Well, we are right up against our 8:30, so thank you guys for keeping in the window. And I would really like to thank our amazing guests here tonight for taking the time out of their busy schedules and bringing all their awesome knowledge to us. I hope everybody at home got some great value out of it. I mean, I think the takeaway generally with this thing is the importance of having a team, right? So you've met some of our team here this evening. They're the trusted experts that we deal with regularly, and we would obviously recommend you add them to your team. But if you don't, we just find somebody who you trust. Again, is going to sit down across the table from you and shake your hand, and you can look in their eye and know they're on your side, and build that team and start now, because heaven forbid something happen to either yourself or a spouse or a loved one or mom or dad or whatever it is, and you're not prepared, you will thank yourself. So where some of it is, where does a realtor fit into all of this stuff? The one thing we do as estate planning is we will provide letters of opinion when Damer's filing a probate application. Typically the lawyers need a letter of opinion. If somebody on this call right now, part of our service will off. Normally there's a fee to provide that letter of opinion, but if you're on this call right now and if you ever need one in the future, you can reach out to us free of charge, and we'll provide you guys with a letter of opinion. So we'll be, again, we're going to email you all the details from tonight, all of the contact information. And if you need any of these people, we highly recommend you give your call. Thank you all very much for being here. Thank you for your time, and thank you for everybody who sat through this. So y'all have great nights.
Thank you.